Yes. Hi, I'm Curtis Barties.
And I'm Dayan Bethel.
And welcome back to episode 5 of the SMC series on the YouTube channel. So if you've gotten this far, we've covered liquidation, we've covered supply and demand, which is the two biggest chapters.
We've covered market structure.
So I think by now you should have had a little bit more of a lesson idea what the SMC strategy is all about. And also you should have at least a few moments in the market using these principles. So I think you should have a demo account by now and basically applying these principles we have touched so far on the channel. So we'll just go on with chapter 5, which is mitigation. I think it's a very short chapter, so I think we'll cover 2 chapters in today's video. So yeah, so if you're new, subscribe, do all the thingy keys on that, and let's get into it.
Here we go.
So chapter 5, mitigation process. Market moves by up and down. I feel like it's already
you see, it's not just me.
Market moves up and down in certain directions. Why price needs to make those retracements. To facilitate their own liquidations, bank and financial institutions will take both buys and sell positions. In a bullish market, more buys will take and vice versa in a bearish market. So obviously you understand that by now. Let's say in a bullish market, banks will create a point of interest or order block by taking both positions. Then we have a bullish momentum created by big moves, big buys. At a certain level, for many reasons, bank will start to take profit on their buys. Those buys take profit will become sell positions that will induce a big move. So obviously this is just theory. We'll look at this thing now to understand this more. The price will stop at a certain point of interest created by the banks said earlier. In these zones, bank will close their losing position at a break-even point or at a small loss, and will take more buy positions at a certain level. So they just understand those.
What chapter was it? Chapter 3 was liquidity. No?
Liquidity.
We did speak about the banks.
Yeah, I think we did speak a bit about this. Yeah. So let's just understand based on what they said now. So obviously, this is where they profit on the buy. So this is probably where they do the buys and then they take profit and go into using sells. So this is what it means when you're taking the sells. So this is just a bearish overflow buy side liquidity, the mitigation process where they do that sell, and here they open new orders, close sell orders like they said, and then basically mitigate their losing position, inducing a big move to the upside basically. So you can see here, this is just another example of this, doing that same procedure right here. A bearish overflow, buy side liquidity, inducing a big move to the upside, which is called the mitigation process.
Simply, the process of mitigation shows how banks tend to generate their own liquidity. Once an order block is mitigated, it loses power. As price has already triggered a part of the orders. There is less probabilities to get a decent position from that one. Personally, I use the 50% of the zone to see from where it could fail.
Okay, so I think this is where they do. So I think we need to zoom in here because the wording is quite
this
small.
comes back to the conversation we had when we said the bank will liquidize all the big boys.
They are basically not fully that banks could control the market, but they have big move financial institutions and banks.
They control the movement of the chart more.
And we retailers are just along there for the ride. So we need to control our hedge basically to ride, which is SMC is basically trading with the banks and financial institutions. So as we can see, possibility for price of mitigation, which is here, mitigation, but not at the 50% level which they talked about here. And as you can see, this is a bullish example, this is just a bearish example of a mitigation using the candles, 50% and more probability to fall. Okay. As you can see, price will likely fail when price reaches its 50% or more. Okay, which is this right here. Just to point that out. Okay, let's move on to the next. The mitigation process in a chart example. So like we've done across the whole series so far, we have looked at just the the lines, and then we look at the chart. So you can see just what we said now, just using the chart. So market deciding its way. So yeah, it's deciding if it's going to be a bearish or bullish. Yeah, basically the bank takes its profit and start the mitigation process where they create more sell orders for themselves, and then here basically they close the sell orders and start new buy orders, which induces here's the mitigation process, and that induces a big move to the up. So when you see this, is good to where we said partially it's good to back test this. So even though we see it now, look at the chart or like a pair and basically compare this where you can spot this out on the chart. So the mitigation process is visible on each time frame, as we know that market are fractality. We've covered that, yeah. But be aware that in a higher time frame, mitigation will be more important than in a lower time frame. So the bigger time frame hold more leverage or more structure basically. Okay.
Let's say we are bullish. When price will make its hour for mitigation, the 15-minute will fail to break off structure. Once the 15-minute will switch to bearish, we will be able to follow the mitigation process in a bearish way until the hour 4 demand.
Okay, so here we go. This is where we use our external and swing structure once again from the first chapter or second chapter. As we can see here, so I would assume this is your swing structure, the line, and then this is your internal structure. Just the inner line.
This was now the 15-minute.
15-minute, yes. The 15-minute is this, and then they showed. I didn't see. I'm still checking off chapter 1, chapter 2. So we can see what it just said: created by the buy side liquidity, possible sell position. So let's just read. On the bullish leg, we can also follow that the 15-minute with buy positions. Once the 15-minute change of character, we start to have probabilities of going down. So yes, is here the 15-minute. Here we have a probability of going down, just to see. But sometimes price can make a change of character to grab liquidity in order to continue its bullish move. Once we break off structure, the mitigation process is applicable on the 15-minute time frame, bearish leg, until the 4-hour demand. So this here is the 4-hour demand already, and then basically that 15-minute here, the possibility oppositions right there. What is this here? Once price traps into the point of view, we look for buys. Okay, so this is just pointing this out here. As we can see, take a clear look at it, enjoy us just doing this, and let's go on. Okay, so basically that was mitigation. Like we said, it's a very short chapter, so as a bonus we'll continue video and go on to chapter 6.
Oh,
the words.
Pricing Mujah.
Go on, as a bonus you get chapter 6 in today's Friday video, so let's go on.
On the S&D chapter, we saw the model of supply and demand. The pricing model will likely use this on the market demanding the trend, depending on the trend. In fact, on the pricing model we have the premium, the equilibrium, and the discount zone.
Yes,
okay,
so
premium,
you guys have heard the terms if you've been
discount.
keeping track of the series so far. We've talked about equilibrium, we talked about discount, and we talked about premium, which was part of the supply and demand chapter, the chapter for last week's Friday's video basically. So
the premium zone, the most expensive place in a leg of the market. Yes, that's where you do not want to come in. In a bearish market, this shows that the price is too expensive for people. This is where the zone is called premium. This is why the zone is called premium. This is why the zone is called premium. Because as the price is expensive and we are bearish, we know that price could likely go down.
yes. As we can see, the equilibrium. This is the 50% of the leg, or basically measuring from your swing high to your swing low basically. So this is the 50% of that. In this area, this is the price is at its equilibrium. Basically it's half of the sellers and buyers is basically in the middle. So there's no good price or no bad price to buy it at this point. So this equilibrium could be used to continue the trend, or price could use it as a liquidity. Okay. The discount zone. So this is the cheapest place in the leg of the market. So this is where you basically wanna place a trade.
This is where your entry points are basically.
In this one. In a bullish market, we have to look for buy in this zone. Yes. In a bullish market, this shows that the price is very cheap. This is why the zone is called discount. Okay, because as the price is low and we have bullish, we know that the price could likely go up and we could enter with a very nice price basically. The model on TradingView can be used. Okay, this is basically on TradingView. We have this tool to measure this out basically. So this is just.
And if you want to know how to use TradingView, I suggest you go check out Curtis's video on it.
Yes, it's
Good plugging.
The model on TradingView can be used with the Fibonacci tool or the Gann box. I didn't think I in the video I covered the Fibonacci, which basically kind of showed the equilibrium. So the Gann box I didn't cover it, by only taking the 0 to 50% or the 100%. So I think here it will show us now.
One
So
to
this
five.
is one of the
to two.
tools on TradingView.
This is basically 1 to 2.
1 to 2, yeah. This is basically a 1 to 2. As you can see, here is your discount zone, 0 to 49%. Equilibrium is your 50%, and then your premium price is your 51 to 100% basically. Yeah.
Yes. As we saw earlier, we have 3 zones. Here, above I present to you the model. Okay, this is he's presenting the model.
Yeah.
Alright.
Okay.
He advises us to look at the model on the higher time frame and not on the time frame of your entries. So not maybe your minute or your 15-minute, but maybe on your 1 hour or your 4 hour,
yes.
or your day.
Or your day, yeah.
Or your day. It's really important to know where you are in the leg of the structure, to not get too fast on the trade, and to not become the liquidity.
Liquidity.
We've been
Yes.
saying that shit.
That's been happening and it's been continuing, and we move. So the price model bullish. So this is basically just showing equilibrium price on a bullish example. As you can see, there's a break of structure before you basically. So how we used to identify is basically taking your swing, your high low to your higher basically, and then drawing it on TradingView down, and basically it will identify your equilibrium, your premium, your discount, and your equilibrium price on TradingView.
On TradingView, I believe this is called a long pause.
A long pause, yeah. As we can see, there's just words here by the author. In the bullish market, we want to buy low, discount this area. So basically, this is that tool you use now, the Gantt toolbox or something. So basically, that exact same in a bearish market. As we can see, you're taking the lower high to your lower low, or lower higher, lower low to your lower higher. So this basically, then you draw it down, and this tool will basically create these zones for you, which will be the middle, your discount, and your premium, basically, in a bearish example. So exactly just what we showed now in chart view. So you can see here, it's exactly the same. Let's just do this. Oh, I can't even fucking do that. Can't even do that, Mr. D.
No, you want to zoom in.
Yep. As you can see, okay, let's just leave it at that point. So you can see here is a few examples of using this, the equilibrium, the discount. So we can see here, throws it down to the bottom. Basically, there's your discounted price here on top. If you're doing this as a bearish example, here's your premium price. Once again, there's the same, your discount, discount, and premium. So you just zoom out.
And if you're on TradingView, this is called a short pause.
Yes. This is very helpful to guide you into a trend and see where you are. Okay. The time frame where you are using the pricing is a 4 hour or a daily to see where you are at swing. So basically, this is your swing lows, which we identified here. Where I use the pricing model. Okay, we've said that. I can also utilize a 50-minute to check the intraday trend where it's needed. Yeah. Fucking the words get a person, bro.
Alright, we're done.
And that's basically chapter 5 and 6 basically of the book, which we covered. 2 very short chapters, so I would say go back in the video and, as always, write it down and make your notes on it. So that's the best we can say so far in these chapters. Gave you more of an insight into supply and demand and basically using this tool. So pricing model and basically just your mitigation process. So in the next chapters, I think all the chapters from here will be a little bit short, but we'll mostly try to do 2 chapters in the video. Well, we'll see how it goes basically, honestly, from here on. So you can see, just as an insight into the next chapter is basically enter on the market, basically when your process. And then the next chapter after that is just see. This is quite a lengthy chapter, so I think that's going to be a video on its own. And then we have trade management, basically just managing your trade. And then after that, we have, I think this was chapter on topic, trade management, still trade management. That's also lengthy. Then we have your daily process, basically of being a trader. And then I think there's 1 or 2 more chapters after this. Yeah, money management. This is not, I wouldn't say this is more related to yourself basically. This is a thing that you work on your own basically, but we'll go over this. And then the last thing is just trader's best friend, which is, I think we've talked about many of this stuff already, like the
I think money
across the
management,
series.
money management is your risk to reward and the calculation of your pips and
all that stuff. So we've talked about that a lot in the channel. So that's basically in the next 2 to 3 weeks basically, and that would conclude the series. So, like I said, if you made it this far, make sure you have a demo account so you can obviously train and basically have time in the market, and obviously use HFM if you're gonna plan on making a demo account, as that will support the channel. So yeah,
Please support us.
so the link will be down below if you want to sign up to HFM and yeah, start trading, start getting time in the market. And obviously this is your training saga, and then from here you'll take it on to the real things. So yeah, I think that concludes the video.
Yeah.
Do the liking, do the subscribing. I'm
All that business.
Mr. Curtis.
And I'm Mr. Perfect.
Yeah, and we'll spot you in the next video.
Peace.
Peace.